What is an unsecured business loan? This is essentially a loan with no collateral, all right? I'll give you an example. So a mortgage is an example of a secured loan. Why is that? Because if you started failing making payments to the lender can just liquidate the house, essentially just sell the house and then just claim back their funds that way. So it's very safe for the lenders, right? With an unsecured loan, it's slightly different because you haven't actually signed anything on a piece of paper that says you take this in place if I started failing making payments. Pretty straightforward. Now, why would you take on an unsecured loan? Well, there's a good number of reasons why businesses take on unsecured loans. Well, one of them is cash flow, another is hiring more staff, another is maybe purchasing more tools. So you get the gist, right? With an unsecured loan, you can use it for anything you want to use it for within the business, pretty much. Usually lenders would ask you for a purpose of funds before they're actually able to offer, but most of the time, 9 times out of 10, you can use it for anything you want to use it for within the business. Now, what kind of businesses qualify for the strongest unsecured loans? There is a wide range of factors that would allow a business to qualify for the strongest unsecured loans. One of the most important factors is probably the revenue, right? How much revenue is this business making? If the business is making enough revenue, there's a good chance that regardless of how bad your credit is, there's a good chance that there is a lender out there that will be willing to lend. Because at the end of the day, there is money coming into the business. A lender is not lending money to a business that has no money coming in, because it's literally impossible for the lenders to claim back their funds, right? So revenue is the most important. Revenue also dictates how much money the lender can lend. So currently, lenders lend at a specific proportion of what your current turnover is. Now, on average, we're looking at roughly maybe about 40% of turnover. So let's say your business is making £100,000 a year, lenders will be able to lend roughly £40,000, just around that £40,000 figure. Now, factor number 2, the age of the business, right? If your business has been around for 20 years and it looks like it's going to be around for another 20 years, chances are there is a lender for you, right? But that doesn't necessarily mean that your business needs to be around for 20 years. If you have filed at least 2 sets of accounts, then you will probably qualify for the strongest lenders on the unsecured lending space, as long as you're profitable. Number 2, profit, right? If your business is profitable, if you have good turnover and you have a lot of profit coming into the business, then you will probably be able to qualify for the strongest lenders on the market, right? There are lenders out there that will not lend to you if your business is loss making. So that's just how it is, all right? Now, what kind of businesses qualify for the worst unsecured loans in the market? If you have a bad credit history, if the director of the business has been involved with a liquidation, chances are there will be very few lenders that will be willing to lend to you. If you have a lot of missed direct debits, chances are no lender's going to want to lend to you. If the lender looks at your bank statements and they realize that there's a lot of loans in there, chances are there will be very, very few lenders that will be willing to lend to you. Now, what do you need for an unsecured business loan in terms of documentation? Usually we're looking at a copy of your last filed accounts and the last 6 months of business bank statements. Pretty straightforward. And how long does it take to get your offer? Realistically, we're looking at about maybe 3 to 4 working days, sometimes 5. The quickest I've seen is literally 40 minutes from sign up to funding. Lastly, let's go on to the cost of an unsecured business loan. Well, because the loan isn't necessarily secured against anything, the lender has to put that into consideration, right? The ease at which the lender gets back their funds dictates the rate that the lender charges, right? So with a secured loan, it's very, very easy for the lender to get back their money because you've literally signed on a piece of paper that says if you start failing making payments, they can just take this back. Unsecured loans are slightly different because you haven't actually signed anything on a piece of paper that says take this if I start failing payments. So lender has to put that into consideration. So for example, on the current market, the average someone will be able to get a asset finance loan for is roughly 10%, and that's because if a person started failing making payments, the lender can just take back the car because they technically own the car, right? So in terms of rates on the unsecured market, we're looking at anywhere between 10 and 20% on average, right? Sometimes it's 50%. People who get offered 50% per annum, it's usually because business hasn't been around for very long, or maybe they had a liquidation in the past, maybe just bad credit sort of thing. But generally, if you are getting very, very weak offers, there must be a reason for that.